everyone, and welcome back to Financial Podcast. I'm your host, Olivia, and today we're diving deep into one of the market's most talked about stocks, Nvidia. Trading under the ticker NVDA. The semiconductor giant is once again at the forefront of investor attention as its fiscal first quarter earnings report approaches this Wednesday after the market closes. And there's a lot to discuss ahead of this pivotal release. As of 10:32 a.m. Eastern Time today, Nvidia shares were priced at $135.33, showing a gain of $4.04 or 3.08%. This increase comes as investors are anticipating the Q1 results and processing a variety of influences ranging from tariff developments to new product introductions and the consequences of export restrictions. One factor contributing to the positive sentiment and recent stock movement is the delay of proposed 50% tariffs on European goods, which has provided a boost to broad market sentiment and lifted chip stocks, including Nvidia. Pre-market activity also showed NVDA gaining alongside other microchip companies like Intel and AMD, indicating positive momentum in this sector. This recent rally is notable because the stock has actually fallen 0.1% year to date, despite staging a 28% recovery over the past month since a downturn that followed previous tariff news. Experts polled by LSEG anticipate Nvidia's earnings per share to see a significant increase of 44.3% year over year for the first quarter of its 2026 financial year, reaching 88 cents. However, another analyst page forecast suggests adjusted earnings are expected to come in at 73 cents per share, and the anticipated EPS estimate of 73 cents is actually a drop from 93 cents just 60 days prior, reflecting some caution due to trade tensions and increasing AI competition. On the revenue front, analysts surveyed by LSEG expect quarterly revenue to climb approximately 65.9% year over year to $43.21 billion, while other forecasts based on LSEG data project a 66.2% surge to $43.28 billion, and Finviz reports an expectation of 66.5% year-on-year growth to $43.37 billion. This expected growth, while substantial, represents a slowing from the 262% increase recorded in the same quarter last year, mainly because of comparisons to an unusually strong base period. Beyond the headline numbers, investors will be keenly focused on management's outlook and clarity regarding the ramp-up of NVIDIA's latest Blackwell architecture, which is expected to be a major driver of projected revenue. Specifically, attention will be on the rollout of Blackwell Ultra GPUs, NVIDIA's high-performance chips touted to offer up to 30% better performance and improved efficiency. The company is expected to provide forward guidance, with Wall Street forecasting full-year revenue of $198.8 billion for the fiscal year 2026. While Nvidia has a history of surpassing Wall Street's expectations, beating revenue estimates by an average of 8.4% over the past 2 years, and CEO Jensen Huang is generally known to be conservative in forecasts, making another beat not out of the question, there are significant challenges on the horizon, particularly regarding international revenue. The major uncertainty investors are hoping to get clarity on from the earnings report is the financial impact of U.S. chip export restrictions on China. In a move to limit China's access to cutting-edge technology, export restrictions were placed on NVIDIA's H20 chip, which was the only AI chip the company was previously allowed to sell to China. This restriction led NVIDIA to state that it would result in $5.5 billion in charges. Furthermore, CEO Jensen Huang mentioned last week that NVIDIA had stepped away from $15 billion in sales in China as a result of these curbs. China accounted for 13% of NVIDIA's revenue last year, and some estimates suggest the loss of this market could amount to as much as $18 billion in annual revenue. Susquehanna analysts have estimated that the restrictions impacted the last 3 weeks of the April quarter, costing NVIDIA about $1 billion in sales. And for the rest of the year, lost revenue could reach $4.5 billion per quarter. Wedbush analysts have estimated the quarterly hit to be between $3 billion and $4 billion. The U.S. chip export restrictions to China also forced a $5 billion write-off on H20 inventory, which is estimated to have squeezed Q1 margins by around 15%, and the write-downs related to H20 shipments could translate to a gross margin hit of up to 12.5%. Escalating U.S.-China trade tensions and increasing competition from Chinese chipmakers and hyperscaler custom ASICs may further weigh on international revenues. Nvidia CEO Jensen Huang has reportedly called the U.S. semiconductor curbs on China a failure, suggesting they have only encouraged Chinese competitors like Huawei to accelerate the development of their own chips. To mitigate the impact of these restrictions and protect its position in the Chinese market, Nvidia is reportedly developing a new, lower-cost AI chipset tailored for China. This new chip, based on one of Nvidia's previous products, is designed with less advanced components to comply with U.S. export rules. According to sources familiar with the matter, this chip is expected to be priced around $6,500 to $8,000, which is significantly lower than the $10,000 to $12,000 price point of its H20 chips. This lower price and adjusted design, which falls just within the memory bandwidth limits set by Washington's latest rules, avoids cutting-edge packaging from TSMC and uses conventional memory capacity. Mass production could begin as early as next month. This strategy is part of a broader effort to regain access to China's $50 billion data center market and potentially soften the blow of export restrictions. Despite the challenges in China, there are other catalysts at play. Washington is expected to modify a Biden-era export curb known as the AI diffusion rule, which aimed to block exports of sophisticated AI chips to China by dividing the world into 3 tiers. The easing of this rule could potentially open up new growth geographies for Nvidia, such as the Middle East, although analysts note the near-term revenue contribution from this region is expected to be small. As part of trade deals with some Gulf countries, Nvidia has stated plans to sell hundreds of thousands of AI chips, including 18,000 of its latest Blackwell chips, to Saudi Arabia. Investors have also found renewed confidence in the commitments from large cloud providers, including Alphabet's Google, to continue investing in AI infrastructure, easing previous worries about a potential slowdown in this area. Nvidia has also declared its next quarterly dividend of $0.01 per share, marking a continuation of capital return to shareholders. The company also plans to extend its AI push into the consumer space with the introduction of its RTX 50 series chips. Additionally, a partnership has been announced with Abu Dhabi-backed G42 and iGenius to construct Europe's most powerful AI supercomputer, which will utilize Nvidia GPUs. Market sentiment towards Nvidia is currently mixed, contributing to a buy, hold, sell debate ahead of the earnings release. Some fund managers are maintaining buy ratings with upside targets potentially ranging from $140 to $220. For instance, Rick Schaefer, a 5-star rated analyst from Oppenheimer, recently reiterated his buy rating on NVDA stock, expressing confidence that the impact of U.S. export restrictions will be limited. His optimism is fueled by the recovery in GB200 rack scale production and the strong ramp-up of Blackwell 200-300 units, which are anticipated to meet or exceed 40,000 units this year. Schaefer also expects next quarter guidance to align closely with Wall Street forecasts. Similarly, CJ Muse, a top-rated analyst at Cantor Fitzgerald, views the Q1 earnings report as a potential turning point, offering clearer visibility into a re-acceleration of revenue in the second half of calendar year 2025. Muse also believes that while the impact from China is significant, it is likely to be balanced by the strong ramp-up of Nvidia's Blackwell product line. Other top analysts from firms including Stifel, Bank of America, Susquehanna, and KeyBank have also reaffirmed their buy ratings on the stock. Despite this bullish sentiment from some corners, other perspectives exist. Some fund managers see Nvidia's valuation approaching full support levels. Several reports, including some from Seeking Alpha, maintain a strong sell or hold stance, citing what they perceive as unsustainable valuation multiples and the potential for underperformance if the company's guidance disappoints. Active managers of large-cap mutual funds have reportedly been reducing their allocation to NVDA, favoring financials and small-cap names, as bond yields rise and valuations across the market face greater scrutiny. Overall, TipRanks indicates a strong buy consensus rating for NVDA stock based on 34 buy ratings, 4 hold ratings, and 1 sell rating assigned over the last 3 months. The average analyst price target is $164.51, according to TipRanks, implying an upside potential of 25.3% from current levels. FinViz reports a slightly different average analyst price target of $162.77 compared to the stock's current price of $131.17. Looking at how other Magnificent Seven companies have fared recently provides some relevant context ahead of Nvidia's report. Apple, for example, reported solid results with increased profits and revenue, but faced a drop in iPhone sales in China and higher costs due to tariffs. Amazon also beat expectations on revenue, which was up 9% year on year, and saw net income rise significantly. However, the market reacted cautiously to Amazon's results, and shares fell as investors were disappointed by its operating revenue guidance and a slowdown in AWS growth. Microsoft delivered a strong earnings report, driven by steady demand for cloud services and AI integration, which sent its shares higher. Investors seemed unfazed even by the increase in capital expenditures tied to Microsoft's AI investments. These mixed reactions highlight the complex interplay of factors like trade tensions, AI investment costs, and specific market segment performance that investors are currently grappling with. And all eyes will now turn to Nvidia to see how it has navigated this environment in the first quarter and what its outlook holds. In summary, NVIDIA's upcoming Q1 earnings report is highly anticipated, not just for its expected strong revenue and earnings growth driven by AI and data center demand, but particularly for the clarity it may offer regarding the ongoing impact of U.S. export restrictions on its crucial China business. The success of the new China-specific chip and the ramp-up of the latest Blackwell architecture will be key factors watched by investors and analysts. While some analysts remain strongly bullish, citing confidence in NVIDIA's product roadmap and ability to navigate challenges, others express caution due to trade tensions, valuation concerns, and potential competition. The results and management commentary on Wednesday evening will undoubtedly provide critical insights into the company's path forward in a dynamic and challenging global market. Thank you for tuning in to Financial Podcast. We'll be keeping a close eye on NVIDIA's earnings results and the subsequent market reaction. Don't forget to subscribe so you don't miss our analysis after the report is released. Until next time, I'm Olivia, and happy investing.